So we're going to go into quickly some sales concepts. This is probably what most of you are here for. How can I sell this and who am I selling this to? So we're going to talk about generational protection, legacy protection, and income replacement. Um, I will note that for all these are just some of the concepts that we have access to. Really, there's very few insurers that you can come across where whole life may not be an option for them. And the great part about insurance is you don't have to necessarily sell them one product. Sometimes a mix of products is the best for the client. But we're going to go through and talk about each of these in particular. So generational protection, it's a gift they can't outgrow. So if you're talking to a parent or grandparent, they can buy them the latest video game, they can buy them, whatever it is, but they're going to outgrow those types of gifts. A insurance policy is a gift that they're not going to be able to outgrow. And with the flexibility of future withdrawals, that gift that they give them at the start could help pay for college tuition, could help fund a wedding, be a house down payment, or be the seed money for a business startup. And what you're providing to these customers is an all-in-one service. You're really talking to customer and talking to the client and saying, I established that insurance is great for you. What about the next generation or the generation after that? Have we thought about the grandkids? Are they fully protected the way that they need to be? We will talk in the generational for the estate on kind of some gifting and stuff, but this is a good way for them to use some of those gifting dollars to kind of have that continue to grow on a tax-free basis. And we do have a lot of clients like yourself that are working with clients in their later ages who are setting up 10 pays or 15 pays for their grandchildren to kind of put the max money in that they can in order to provide that that legacy for those children in the future. And then speaking of legacy, whole life insurance is great for legacy protection, estate planning, leveraging your gift tax exemptions, business succession planning for funding ILETs. A lot of these advanced concepts I would recommend we talk to a brokerage manager on as you have any of your clients that have these particular needs. But whole life and those guarantees behind it really kind of help fit that need of what the client's looking for. Hey, I want to make sure that this money I'm putting in today is going to be there and grow in order to protect my estate that I'm expecting to be XYZ in the future, and not have to worry about, am I going to need to continue to fund this? Is there going to be additional need for monies later on? Is the value not going to be the same? Whole life really kind of helps these types of clients have peace of mind of knowing that the planning that they're doing is going to be the planning that happens when it's time for those assets to pass on. And then what we'll show as some of our case samples is what a lot of clients are going to ask for is going to be income replacement. Now, first off, like I said, this is a non-correlated asset. So that means tax-free withdrawals. It's not going to be tied to the market and performance. And it can be a supplement to other income sources. It doesn't need to replace everything. It can, but it doesn't need to be the sole way that the client has to, fund their retirement. A good thing about whole life insurance, it has no mandatory withdrawals. So unlike an annuity or some other assets that may force a mandatory withdrawal, whole life is there if you need it. And if it doesn't, you pass on that death benefit to the next generation if you end up not needing the value that you've accumulated as a living benefit. So the case study we're going to look at first is by Ernst & Young, or EY as some may know it by. This was an independent study that they did of retirement income and legacy portfolio transition, basically meaning they looked at what a person could get in these different scenarios for both income or passing their portfolio on to the next generation. It shows different types of strategies among different asset classes. But one of the main things is they use participating whole life for its insurance component. And they particularly said that the way that the whole life performs was why that they chose it to be kind of the stake in the ground for being the insurance component of this study. there's a link down there, and we can send that to anyone that would like it for the full study. It is free to read through. I am going to just kind of show some segments of it, but it's an interesting read to kind of show how a overall portfolio with participating whole life in it can help a client. Because a lot of us are going to have clients that are going to say, you know what, I'm going to buy term and invest the rest. If you ever had a client that says that and you're like, okay, what does that actually mean? So if we look at retirement income for this with a buy term, invest the rest, you're going to look at a couple different options. You're going to see what it is for investments only. The bottom three are with a percentage of that portfolio money being spent on term insurance and the rest on investments. And then that middle section, the 10% PLI, that's participating life insurance, that whole life, and then the rest of investments. And you'll notice that for both income and legacy, that those ones with participating whole life and investments kind of gave the most. I kind of highlighted that 30% because it had a good mix of retirement plus legacy. But as you see, as the client needs change, they can do more or less, and depending on what they're putting into different segments of their portfolio will result in kind of how that portfolio performs. But showing that whole life being added to it as opposed to just buying term and investing the rest is going to give them a greater portfolio than just doing investments or the term and investment. So another thing that we often hear is, I'll use annuities for income. Other than what we previously said of annuities require that you do make mandatory withdrawals and you may not want to or need to make those withdrawals versus whole life. I will say that, a deferred income annuity with income inflation protection plus investments does produce some great results for retirement income versus your investment only, and does add some to that legacy at the time horizon for when it's being passed on. We'll kind of segue that into what wouldn't be kind of the best strategy. As we'll see, the term only is kind of off this chart because we've already established that's not kind of the best way, but you will see that some of these figures with both participating whole life with a deferred annuity and then the rest of investment are going to give you highest mix of income at retirement as well as a legacy to pass on. So really this is about finding what's best for your client and kind of figuring out what is it that they're looking for, what needs do they need to be met, and showing that not one product is a problem solver for everything, but that good mix of products as well as whole life can provide that income plus give them a legacy at the end versus just putting in investments versus just putting it into annuities. So you kind of get the best of everything with that mixed strategy. So now we're going to go and talk about a non-correlated example. Once again, this is that same 20K a year for 10 years that we talked about earlier that was showing $28,000 a year over 20 years. But this client's going to use whole life insurance to protect against down years in the market. The EY study showed kind of annuitizing everything and taking out the same withdrawal across all assets. But realistically, a client is going to take from their best performing assets when they need to, and then leave those to recover when they need. So whole life insurance has a great way to kind of protect against the market, and it gives them a way to kind of have access to cash value in the years that the market goes down. So in this example, we're showing every 4 years, starting at age 66, a withdrawal from the insurance policy. This is to simulate the down year in the market. We can't predict what year will actually be the down year, but as history has shown, the market doesn't go up every year. There are times when the market is down overall. So when the market's down and your portfolio's down in your correlated assets, whole life is great to lean upon and say, hey, you know what? I'm going to take the money out of my whole life contract now and let my market assets recover this year and then maybe take from them next year. And you see with this type of deferred strategy where you're only taking it out when needed, you can actually take out a lot more, and you'll up to 105,000, which is around 124-ish of value that they would have to take out of like a stock portfolio to gain that income that you're getting from the tax-free whole life. So this is a great example of showing the diversity of whole life and showing that the down years in the market aren't going to affect whole life in the same way. This policy is still going to grow, they're still going to get performance, and then you can lean on it and tap on it in those years that the market is having those downward effects.